think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. I'm your host, Daryl Thomas, and today you are in for a treat. Today we interview the great Dr. Nomi Prins. Nomi Prins has been active in the banking community for a long time, and she writes about her experience being on the inside of big banks. Her previous experience includes being at Lehman Brothers, Bear Stearns, and Goldman Sachs. Nomi frequently writes about how the Fed has rigged the financial markets and the economy. She is the best-selling author of the book Collusions, as well as All of the President's Bankers. Her recent book, Permanent Distortion, which we will be talking about today, is amazing, and I encourage you all to tune into this interview as she provides some insight from her experience, and so we get to learn from someone who has been in the belly of the beast and is now educating the average person. So before we get into that, please hit the like button, hit the subscribe button. Please look at this statistic here. Over 90% of the people that watch my channel have not subscribed. This is disheartening, but I hope that you all will support the channel in this easy way by hitting the subscribe button. And also I will have a couple of ads that will show up throughout the interview, but consider watching them and consider supporting the channel in that way. I want to thank you all for joining me today. Now, without further ado, let's get to the interview. Hello, Dr. Nomi. It's good to have you here with me on the channel today.
Thank you so much, Daryl, and you can call me Nomi.
All right, thank you. Will do. I'm very casual. I like to humanize everyone, and you know, I know how it is. You know, me, I'm a director at a school district, so a lot of kids, they call me by my first name, so I try to make it personable.
Absolutely.
So I'm glad to have you on the channel today. It was amazing just seeing you speak at the Rural Symposium back in July. And you spoke about a lot of things that were developing in the financial markets and where people could potentially be looking for how to protect their wealth and everything. And so I do want to dive into some parts of your book as well. So a couple of things that I had pulled out from the book where you used a really, really good quote coming into the book, the first chapter. You said, "What is really amazing and frustrating is mankind's habit of refusing to see the obvious and inevitable until it is there, and then muttering about unforeseen catastrophes." This is from Isaac Asimov. And so I was watching a movie called Too Big to Fail, and it was talking about the banks. And there was a particular point in the movie where this government official is going on a jog, and he's just looking at the average person. And the average person had no clue that we were on the brink of an economic collapse. And for me, I would have been toast in 2008. I was working at a warehouse, spending my money unwisely and everything. And so, but you were in the belly of the beast. You were close to the people, you know, making these decisions and such. You knew the system and everything. What was the sentiment like for you and those around you during that time?
Yeah, I mean, that's a great question. And you know, the person that you're referring to in Too Big to Fail in the book was Tim Geithner, who became the Treasury Secretary along the way, and who said that the average person didn't know what was going on. But in fact, he is not an average person. He was very much a part of the system. He was at the New York Fed. And then he moved on to being the head of the Treasury Department. So, I mean, that's a pretty lofty shift there. That's not really connected to the real world. I left Wall Street as the seeds for the financial crisis were being sown. So I wasn't working there in 2008. And I wound up writing a book in 2004 called Other People's Money, The Corporate Mugging of America. And that was the first book I wrote. After I left Wall Street, I had been a managing director of Goldman Sachs till 2002. Before that, I'd been at a number of other banks, Chase, Bear Stearns, which failed, Lehman Brothers, which failed in the financial crisis of 2008. So I did know a lot of people who were still at those institutions as they were imploding. First, Bear Stearns in March of 2008, and everybody said, "Oh, this is just a unique situation. This big bank, it's been around for over a century. It failed. It's a one-off." And then 6 months later, in September 2008, Lehman Brothers, another very long-term financial institution in the United States, fails. And at that point, the government stepped in to bail out a number of the remaining banks, and also to create a basically bailout that was perpetual in the form of Fed policy. The government didn't do this specifically, the Federal Reserve, which is supposed to basically be the last resort of protection for these banks, went on overdrive and printed a whole bunch of money, about $4.5 trillion worth of money sort of out of nowhere, in order to give to the banks, in order for them to get through the financial crisis that they in fact had caused. From the period of early 2000s through 2008, they were on the building blocks to causing what became the financial crisis of 2008, and we're still doing that. These institutions that survived that financial crisis, J.P. Morgan Chase, Goldman Sachs, Bank of America, with Fed help, both the federal government and the Federal Reserve, are doing okay. It's the regional banks, the middle of the country banks, the banks that lend to small businesses and small communities. Those are the banks that are really struggling and failing in today's environment.
Yeah, and I know, many of these banks bought a lot of government debt at very low interest rates, and there's some liquidity problems there, which is what I believe happened with Silicon Valley. So you mentioned that in one piece of the book, which I want to get to the current situation a little bit later. One piece of the book you had wrote, and just everyone, if you have not checked out the book yet, I encourage you all to pick it up. Permanent Distortion. It's really, really good book. I'm still reading through it. I'm not all the way done with it, but I'm still getting through it. But you wrote that one key rule that arose in 1933 in the wake of the great stock market crash of 1929 managed to survive for decades, and this was when the Banking Act of 1933 was passed, and it was pretty much there to protect us from something, right? And then in 1999, the Clinton administration, by a vote of 90-9 in the Senate, wanted to repeal that act, and out of this act was the FDIC.
Yes.
And so the FDIC, I mean, you wrote that the FDIC was buying mortgage-backed securities. Is that correct? Were they engaging in the financial games and kind of the clown show of what was happening?
Not so much back then. They were basically created as a sort of balance to the Banking Act of 33, which what that bank did, it happened, it was passed after the great stock market crash in 1929, right? As you mentioned. And what it did was it required banks to separate their most risky activities from using other people's money, from the deposits of everyday working men and women, their customers. They could choose to be risky and become what was called an investment bank, and do whatever they want, invest whatever they want, however they want, or they could protect that money. And as an additional way to protect that money, if they chose to do that, the FDIC, the Federal Deposit Insurance Corporation, was created. And the idea was that banks would basically give money to this insurance corporation, like insurance premiums. And if something happened to them, the FDIC would protect the deposits of their customers. And we know this now to be up to $250,000 per account. The problem with the FDIC, the bigger problem is not what they're protecting, but it's the fact that they don't have enough money today and along the way to be able to cover the possibility of too many people taking their deposits out of banks at the same time, which is what we saw in a snapshot recently with the failure of Silicon Valley Bank, Silvergate, and First Republic. These are just three regional banks where people took their money out. And the banks didn't have enough liquidity capital to cover it, and so they failed. And a lot of banks are still in danger of this. So the FDIC was created to avoid this scenario. But unfortunately, over time, the banks have taken on more risk or more investments in mortgages and treasury bonds, et cetera, than they could liquidate for cash if depositors were to take their cash out of those banks.
Yeah, that's that. Thank you for clarifying that for me. So the FDIC was indirectly ensuring bad behavior. I mean, like if you were to be a doctor and to get into an accident, your insurance would likely not cover you because you are a risk. And so the FDIC was still insuring the banks while this bad investments and everything was still going on.
That is exactly right. And Gerald, very few people, even in the banking system, in the parts of the government that are supposed to be focusing on financial security, could have put it as clearly as you just did.
Oh, thank you. I appreciate that. So what would your response be? So like, I kind of think what you would respond, but because a lot of people are like, hey, I'm FDIC protected. Like, you talk to the average person, like every time I talk with someone about the banking system or such, that, oh, we're protected, like there's no risk at all. And I think the FDIC has a certain, I think, 100 billion or something, and they're backing like trillions in the banking system.
Yeah, they're backing about 1.7% of the total of people's deposits that are up to $250,000. Now, to be fair, most people don't have $250,000 in a bank account. So when we think of this, we're thinking about money that's spread out through many, many accounts. But the total of what that is about 1.7% of what the FDIC has in reserve if everyone were to take all their money out of banks, say in some major crisis or confidence drop at the same time.
Wow. Yeah,
and then everybody else after that would be caught uninsured. I mean, that would be the situation.
That's alarming. Very alarming. So you also wrote something in the book, very comical, regarding the SEC and Charles Ponzi. And the Ponzi scheme was named the Securities Exchange Company, and the SEC is called the U.S. Securities and Exchange Commission. And I watched a documentary about. It reminded me of this documentary about Bernie Madoff. Mm-hmm. And how the SEC looked like some straight up clowns, in managing that situation, or even, it seemed like they were involved and such, and like they didn't have any type of boundaries around the people that were engaging with Madoff. Is that still the case now? Like, what's your take on the SEC now?
Well, I think the SEC tries to do its job. However, it doesn't. When it comes across these really big growing problems, it tends to be late, and it tends to ignore warning signs, like in the case of Madoff, that have been sent to them. I remember I was visiting one of the former SEC commissioners during the Obama administration, but and he said to me, Nomi, if I could show you the amount of boxes down in the basement of the SEC that have proof that we could use in order to investigate or potentially fine criminal activities, it would astound you. But the reality is, we do not have enough people power. We do not have the budget to hire enough people power to actually go through these boxes. Now, obviously, a lot of stuff is now electronic, and you still need people to go through things. And maybe one day there'll be some AI program that can do it. But the reality is, in this interim between what Madoff was doing, where there are still probably accumulated frauds out there that have been perpetuating for years, the juxt of that conversation was that it just doesn't have the capacity, the SEC, to really do its job properly.
Yeah, I can I can relate to that. I guess that's probably similar with the IRS or something as well. So leading out of the financial crisis, we obviously had QE, quantitative easing, go on for over a decade, and this led to which a lot of what you talk about with the permanent distortions.
Right.
And so, what's your take on? Obviously, QE has led to, in 2020, we saw massive amounts of billionaires created. I mean, you went through just some, with a fine tooth comb, the statistics. And one quote you mentioned was from Oxfam International's executive director, Gabriella Butcher, saying that the 10 richest men in the world more than doubled their fortunes from 700 billion to 1.5 trillion during that time. And so obviously, that happened. Many people, I even relate this to the average person. I mean, you could just throw a dart at a board and any crypto coin could go to the moon, right? And everyone felt like they were the best traders and on top of the world, right? That was a massive distortion. Hey everyone, sorry for the break in action, but I have to let you know that I am now an affiliate with Miles Franklin. Miles Franklin has been a bullion dealer for over 30 years, and they provide some of the highest quality service to their clients, as well as fair pricing on bullion products. So purchasing bullion through Miles Franklin not only stores wealth for yourself, but you're also supporting this channel to continue to provide free educational material for retail investors and those who may not be aware of many financial concepts that I discuss on this channel. So you can get started by sending an email to info@milesfranklin.com or calling 952-929-7006. Be sure to let them know that Daryl Thomas or the Money Level Show sent you, and I will receive credit for your service. I thank you all for considering this. Now let's get back to the interview.
Yes, absolutely. And hence the book. I wrote that book during COVID. and it was because, as you mentioned, quantitative easing, or QE, which is a very wonky term, basically means that the Fed, or central banks, who are these institutions that don't really have accountability to citizens, can just create money when they feel it's necessary. And in the case of the United States, the Federal Reserve is the central bank. It can create money that it, by just mechanism, just the way it's set up, can effectively give to the larger banks in return for treasury bonds. That's the deal. Meanwhile, the banks can take this money and do whatever they want with it. That includes lending it to whom they want. That includes investing themselves. That includes investing with their friend banks or their friend asset managers. The result of all of this is that when rates were at zero, they were at zero after the financial crisis of 2008. They went up a little bit. They got as high as 2.25%, and then they went right back down to zero when COVID started. And the Fed started printing trillions and trillions of dollars that went through this process. And because there was all this money going into the system through the big banks, it needed to find a home. Where did it find a home? In crypto, in certain stocks, in certain bonds, just kind of wherever it could. And as a result, everything was kind of going up at the same time. And there wasn't really a thought to differentiating what was going up because it had value, like true value, and what was going up because people were buying it or institutions were buying it. And so that's what I mean by permanent distortion is the scenario was that all this money is being created. It was going wherever it could find a place to multiply itself without really that much analysis. And people were getting very rich at the time. And when you took that sort of idea that money would be printed sort of forever, which was the psychology that kind of went along with this at the time, and the Fed started raising rates and stopped printing as much money, and started sort of reducing the size of the amount of money available to banks, things started getting wobbly. And so the other side was Bitcoin went down. Other currencies went down significantly. Stocks went down Fangs went down. A lot of things just basically that had been popped up went down. Now, some of those things have come back up. But that's also part of the permanent distortion, because I believe that's partially because even with the Fed raising rates right now, and even with Federal Reserve Chairman Jerome Powell talking about how the Fed's going to keep on fighting inflation, be vigilant, and it's going to be painful, but it's going to work out for everyone, and all the stuff that the Fed just kind of says. If push comes to shove, if JP Morgan Chase were looking at a massive hole in its book, a massive potential loss for whatever reason, or some other large bank, the Fed would print more money in a nanosecond. And we saw that earlier this year with the Fed printing about $350 billion out of nowhere, post-COVID, while it was in a tightening mode, while it was raising rates, to give to banks like First Republic to make their depositors whole and so forth. They can do that at any point in time. So I think we remain in this permanently distorted environment where whatever is happening, the expectation is that money can be printed whenever it is needed. And the reality has proven that. It's not happening this particular second, but that ability, that still exists.
So I do want to talk a little bit about interest rates. So I've heard some perspectives that interest rates are cyclical. In the current environment, it seems like that's the only tool that the Fed has when something breaks is to lower interest rates and to print more money, right? Quantitative easing. And we're in this, it seems like we're in this weird, spot, with inflation still being elevated. We still have energy supplies that are inventories that are down. Especially, with oil and things of that nature. And then you still have a war going on in Russia, Ukraine, and you're seeing all these nations start to make these energy policies and decisions that affect other nations and such. And so it seems like the Fed has no control either way. What's your take on all of this?
The Fed has absolutely no control over what happens in global energy policy, literally zero. And I continue to say this, and it seems like they don't listen. But they haven't really admitted, nor will they, that they actually cannot control the sort of significant components of inflation, like inflated oil prices or food prices, for whatever other reasons that they're inflated, which is whether there's not as much supply, whether there's production cut by OPEC or Russia, whether there is the ongoing war of Russia on Ukraine, curtailing wheat supply on the commodity side. All of these things have literally nothing to do with the Fed, and they're not in the purview of the Fed to be able to control. So when it talks about controlling inflation by raising rates, it really hasn't. There have been incidents of inflation coming down at the same time that the Fed was raising rates. But if you look, for example, at oil prices over this year, oil prices are at highs for the year. Gas prices are high for 2023, are highs for the year. And interest rates have continued to go up more slowly than last year, but they have continued to go up this year. So Fed raising rates to fight inflation, oil prices inflating through things that have nothing to do with the Fed. That's just the reality. And so there is this disconnect between what the Fed says it can do and the just general anxiety that puts into markets and just people's ability to pay for mortgages or car loans or any of those things, all of which have higher and higher delinquency rates now, and default rates are creeping up because payments are more expensive, while they can't actually control commodity prices at all.
Yeah. It's I always tell my audience, the Fed can't, print energy, they can't print oil, and they may be able to temporarily impact demand, with interest rates and such, and sucking liquidity out of the system. But at the end of the day, the inventories and our national policies and production has to increase in order to, curb that inflation. So the Fed, so the Fed is obviously, in a pickle, and we're at the point where our deficits are, 1.5 trillion. Our national debt continues to balloon, right? I think before the year 2000, we had less than 5 trillion in debt, and now we're, going on 33 trillion, something of that nature. How does this end? It seems like it's going to end badly.
It's really bad. I mean, and again, this is where, I mentioned the banks that are failing. I mean, one of the things that we're seeing is that banks who bought treasury bonds in order to, sort of store their money safely in the case of risk on their side, whether through bad decisions or depositors leaving or whatever, have seen the value of those treasuries go down as rates have gone up. And also at the same time, the government has been borrowing more money at higher rates. So that means the cost of their borrowing has increased at the same time their debt has increased. And unfortunately, this is also a situation with individuals. The total amount of credit card debt, for example, in this country today is at record highs. And it's not at record high interest payments, but it's very close. The amount of interest that credit card companies are charging for that debt. So it's like there's more and more debt and it's more expensive. That's not a good situation for a country to be in. It's not a good situation as we know as individuals for people to be in. And people are very stretched. And using this debt in order to afford basic items. So the Fed's tinkering around the edges, but the reality is the big picture is the massively escalating debt of the country, the massively escalating cost of servicing that debt, which is now about 1% average GDP. That means that if GDP is growing by about 2.5%, which is very small, which is about what it's growing right now this year, about half of that growth is basically coming from our payments on our debt. It's not actual growth. The Fed doesn't appear to understand this, but that's just the math. And again, that's not good. If the value of treasuries continues to go down and interest rates stay where they are, even go or start to creep up a little bit more with, the continuation of this policy of the Fed, again, not as aggressive as it was last year, but still there, it becomes really difficult for people to borrow money to pay for that debt, for the country to borrow money to pay for that debt. And so, you just push that entire problem on a national level and also, in our own homes to the future. At some point that there are breaking points, and usually these breaking points happen to people before they happen to governments, because, the US government has just allowed itself to continue to increase its debt for the next 2 years. That was the deal that was struck in May. For now, that means at that time debt was just under $32 trillion. Now it's just over 33 trillion. That's in from May to September, that we basically just borrowed $1 trillion more, right? And we have the potential to continue to do that, for another 2 years after this May. So we're talking about, $3-4 trillion that I would not be surprised is added by May 2025. And again, at higher rates and higher servicing, all of that comes out of real economic growth. Yes, the government still funds things. Yes, we passed an infrastructure act. Yes, we have certain commodities that are prioritized by the government, by the Department of Defense, that we need as a country for national security, national energy policy. But at the same time, the amount that we're borrowing is increasing by more than our ability to use that money to grow our economy. And the Fed's just merely kind of in the way making noise about why growth is a problem.
Yeah. Wow. This is
it's heavy. It's heavy. And it's to me, it's very clear that this is just what's happening. And as people who get into high debt know, unless you start to pay it down, or unless you sort of use what you've borrowed to whether it's to create a business or just to do something that can eventually at least pay off that debt and hopefully also create positive cash or returns. After that, you're in a sort of ever growing hole, which is kind of where our country's at.
Mm-hmm. Yeah, there seems to be these competing. Well, it seems like you have the government spending and you have the Fed tightening, and they're competing with each other right now. It's
like they're not talking to each other. They're just making each other worse.
Yeah. This is very interesting. And so I want to get your take on, I've asked a few people that have come on my show about retirement. So, I reach, different ages of people. For
Mhm.
me, I don't think Social Security gonna be there when I get the age 65, or they may push the age to 100 years old or something, right? You know, so I just don't foresee it being there. I mean, it seems like the government is having to, increase budgets. They're having to spend more money to keep the average person afloat. And I mean, they're talking about another cost of living adjustment next year. And nothing against like the people that receive those, like I know a lot of people that receive those, but we're spending money that we don't have, and this money has to come from somewhere or something is going to happen. So I'm just kind of wondering, like, where is this money gonna come from, or what's gonna have to give.
I mean, those are very excellent questions. And, with something like Social Security or Medicare, basically those government programs where people have effectively paid into those programs. And the idea is that the government is sort of, safeguarding their contributions at some sort of, inflation or cost of living adjustment. That's going to continue until the government can't, sort of borrow anymore to cover all of that. And Social Security has some protections around it, as does Medicare, because people have paid into it. As our demographics change, as there are fewer and fewer people to basically input money into the Social Security system, and more people living longer and drawing funds from it, that's just going to continue to stretch that situation. And how that breaks, is that the people coming into the system are just going to either not have it there, or more likely have a very, very small to potentially insignificant amount that they may receive when they do retire, because it's simply, even if you're printing or borrowing to sort of make up for that differential, it's at some point there's simply not enough money coming into that system and not enough money being borrowed to maintain it. And there are two things that will happen. Again, one is people coming into Social Security won't, as you say, have it, or have something, really, really insignificant when they're of age, or Social Security rules have to kind of be changed. In other words, and this is not popular in Washington or really with people, but have people who make more put more into Social Security. That's not popular because it sounds like you're taking from the rich to give to the poor, and that's not popular among the rich. But that's to really just balance out the demographics, potentially. But unless any of those things happen, the printing or the balancing, at some point there will not be enough money to create adequate payments, meaning payments that can cover like any portion of rent or whatever, for people that are sort of at the early stages of that, entering that system now. However, for people that are older, that are watching your show, my recommendation is that you keep your money. If it goes away, it's not going to happen like in a second. This whole budget noise that happens with Congress people, arguing back and forth as to whether or not it's going to get approved, and is the government going to stop, and all that stuff all works itself out. The government's not going to stop. There's definitely pockets that can reach. Agreements are going to be made. It's just going to be embarrassing, as spectacle. But if there is ever a point where Social Security will be tailored down, I think that will be notified to people. It's not going to be like tomorrow all of a sudden your payments are going to go away. I think there's going to be a long enough term that people have the ability to make those decisions, to take money out in lump sum. I mean, I think there'll be deals at that point. We're not at that point but at that point, people who are sort of further along the system or older should just pay attention for those things happening and just make the decision accordingly. If the government says in 6 months, we're basically giving you a choice between a lump sum or, a decline in your payments over the next X years after that, well, then take the lump sum or whatever it is, make those decisions at the time. But for now, if you put money into it and you're receiving the amount that you expected and you haven't heard that notification, you can trust it for now.
Mm-hmm. And Lord have mercy for whoever's in office when that time comes.
Yeah. It's or we could just see data like 50, 60, 70. It's not, we do have the ability to continue to borrow. It's not a good look. It doesn't go into growth, but I mean, we have seen more than doubling of our debt in the last sort of decade less. So I mean, it's not like that can't happen.
Yeah. Yeah, and it seems like this plays into like a bigger picture of, I mean, nations rise, nations fall. I mean, you get the debasement of currency. At some point, the dollar is going to be devalued even more. I mean, I don't know if it'll be pennies on the dollar at some point. I don't know if when it gets at 99%, it's just going to be 99 point, whatever, right, of its previous worth, and so or lost that value of its previous worth, and so. We have this whole thing with the BRICS, new Bretton Woods, and I mean, other nations seem like they are, frustrated with the faith and credit of the United States government and such, and how you write about this, how, the Fed makes these decisions that impacts international economies and markets and such. And so, what are you foreseeing there?
Yeah, so I mean, I wrote about in my last book in Collusion about how my prior to this book Collusion, before Permanent Distortion, which is the one I just wrote, but they're kind of companion books. And in the wake of 2008, all the central banks around the world, especially the ones that were like non-G7, so the ones that were looking from the outside into what had just happened, which is that the financial system had just imploded in the United States, and that had economic ramifications around the world, not just cutting rates to zero, but just with really hurting economies throughout the world. And so these nations started to say, all right, well, we need to really protect ourselves against the dollar and against monetary policy and banking policy in the United States. So this idea of a BRICS bank, which was subsequently renamed the New Development Bank, began. And the idea of that was to just kind of put a foot in the sand of nations that weren't part of the Bretton Woods sort of agreements post World War II. They weren't sort of interested in being dependent on the dollar and dollar levels forever. And they started to find ways and to have conversations and summits about breaking away, whether that meant trading with each other more, so that there was no need to convert that currency, that exchange, back to dollars first to basically trade goods or services or buildings or infrastructure or innovations or whatever it might be. And then recently, fast forward 14 years, the most recent summit of the BRICS was the first time where those countries, so Brazil, Russia, India, China, and South Africa, had both invited other countries to join their bloc, and had also approved 6 new countries to join. And important amongst those countries, for example, Saudi Arabia and the UAE are oil producing nations. And one of the reasons that's important is because you've got these countries that already want to have an alternative currency to the dollar, or at least want to increase the amount of activity they have with each other that isn't dollar based, which is kind of a similar way of doing that, and also having energy. So what that does is it changes sort of the geopolitics of oil and energy in the world, because now Saudi Arabia doesn't have to just be dependent on the petrodollar, basically purchases of oil around the world to be based off the dollar. They can be traded with, there was just the first UAE trade of, I think it was 1 million barrels of oil were bought by India in rupees, right? So instead of in petrodollars. So basically taking the US out of and the dollar out of being the middle country from a currency perspective. So this is just something we're seeing. It's growing. I would say it's at like infancy. It's kind of like a toddler, and it's not going to take the US dollar out of commission. The economy is too big. The US is too powerful on so many levels and has a lot of allies, that help that. But it's definitely moving a lot of other countries into a space where they feel they can be less dependent on transacting in dollars.
Yeah, definitely. So Nomi, as we begin to wrap up, I think about my family, and many of us work live paycheck to paycheck, and there's a lot of people out there that are unaware of these things that are developing, these things happening in the background and such, and mainstream media does not give us this information.
Right.
And so that's why I'm definitely appreciative of you coming on. What should people be doing? I mean, at the Real Symposium, you mentioned that obviously real stuff, resources and such. I recently had Neil Howe, author of Fourth Turning, on recently, and he talked about, people are gonna at some point are gonna have to invest in real stuff, like gold, resources and things of that nature. And so I wanted to just get your take on like how people can be preparing and I mean, because we could wake up one day and just like the quote that in the first sentence of your book, like we could just wake up one day and things could be in shambles. So what's your take, and what do you think people could be doing now? Hey everyone, sorry for the break in action, but I have to let you know that I am now an affiliate with Miles Franklin. Miles Franklin has been a bullion dealer for over 30 years, and they provide some of the highest quality service to their clients, as well as fair pricing on bullion products. So purchasing bullion through Miles Franklin not only stores wealth for yourself, but you're also supporting this channel to continue to provide free educational material for retail investors and those who may not be aware of many financial concepts that I discuss on this channel. So you can get started by sending an email to info@milesfranklin.com or calling 952-929-7006. Be sure to let them know that Daryl Thomas or the Money Level Show sent you, and I will receive credit for your service. I thank you all for considering this. Now let's get back to the interview.
Yeah, I mean, just on a lot of the things that you've just said, Daryl, I'm a big believer in real assets that have real use value, meaning you can build stuff with them. You need them to power the world. You need them to transform the way we power the world, and you need them to preserve value because they are tangible and they are real. And along those lines, a lot of what you said, gold, silver, copper, metals, materials that are part of what we need to do to effectively both build our world and also retain some of the wealth, or preserve it or grow it along the way that isn't on paper. Again, we talked about the Fed can't print oil, it can't print gold, it can't print copper, it can't print uranium, it can't print cobalt, it can't print many about 50 or so defense rare earth minerals that are on on our national security lists. And I think, not to get into a chemistry lesson, but a lot of these elements I think will continue to hold value and grow in value because we need them and because we can't print them. So I think it's important for people to just sort of get educated on that area. Mining commodities is a very small part of where people think of investing when they do invest. And I know this isn't an investment show, but if we think about just where you kind of want to consider positioning your future, it's something to dig into and get educated on, those particular areas. And if you can use it and touch it, it has value.
Mm-hmm. Yeah, definitely. That was, like you said, something very simple there that really just had a light bulb go off in my head again. And when we say owning something, even though you may not physically have the oil in the barrel, like you're owning a piece of a company, a part of a company, a share of a company or such. And so it's important to have that mindset whenever you're owning natural resources or looking into that, which we talk about that quite a bit on this channel, natural resources. And we believe we're in a commodities bull market, and the governments are passing all these policies to, carbon emissions and all these things. And we don't even have the supply yet. So I think that's where we're headed. So you recently obviously just released a book last year, almost a year ago, right?
Yeah.
And so I encourage you all to go pick up this book because it's very important, and it has some really good information that can save your financial future, I would say. And then also you have a emailing list, and so I wanted to give you an opportunity to speak where people can find you, sign up for that emailing list and such, and things of that nature.
Thank you so much, and thanks for having me on, Daryl. It's been such a great great conversation. I really appreciate it. So my website's really the best place, www.nomiprins.com, but on there's a drop down to just join my mailing list. It is private, it is free, and on it is really where I'm least filtered. In other words, I write once a month to people just about where I've been, what I'm seeing in the world. Recently, I was just in Norway, checking out what they're doing in hydropower, and what we can learn from that, and what the trend is with respect to that component of the energy spectrum. And so it's something that allows me to share on a private basis with people. So I encourage people to sign up so we can stay in touch.
And she doesn't spam you with a bunch of emails, you all. So
that's one time a month. That is it.
That's good. That's
and
good.
It's not even the same day each month. So it's when I have something to say.
Yep. So I'll be sure to link to those in the description below. And Dr. Nomi, I feel like I did my homework. It was good engaging with you in this conversation. And everyone, be sure to click the links in the description below to support Dr. Nomi. And thank you for coming on today.
Thank you so much for having me.